Innovating for Insurance, S&P Mark 5% Index. S&P Dow Jones Indices, the leading provider of market indices for use in insurance products, created the S&P Mark 5% Index, a diversified and dynamic multi-asset strategy to manage market volatility. Because we know that global capital markets are constantly fluctuating, making it crucial for investors to mitigate the impact of unexpected dips. The index uses a simple risk-weighting framework, tracking 3 underlying component indices that represent a diverse mix of assets: equities, gold, and treasuries. Why are these 3 asset classes the right mix of ingredients? We use equities because large cap stocks have historically offered strong potential upside, and the S&P 500 has served as the backbone of insurance products for generations of investors looking to protect against the unknown while also moving toward their retirement goals. We use gold because the precious metal offers a hedge on inflation, increasing the potential to stay a step ahead of rate cuts or dips in equities. We use treasuries because these are the bonds that investors often look to as a source of steady income. So what is the right mix of ingredients to unlock potential upside, protect on the downside, and manage volatility all at the same time? Simply put, there is no one answer. It all depends on what's happening in the market. As a result, the S&P Mark 5% Index is designed to be dynamic and adjust to current market conditions. Let's take a look inside the strategy and see how it works. The goal of the strategy is to maximize potential returns while keeping risk in check. But since market conditions and volatility are constantly in flux, the mix of ingredients needs to be able to change and control risk. As a result, the S&P Mark 5% Index is designed to change its allocation recipe on a daily basis in order to keep its recipe for success up to date. So what does that mean? In low volatility environments, the S&P Mark 5% Index risk control mechanism increases market exposure to riskier assets by increasing the equity allocation in the index up to a leveraged position of 150%. This additional exposure to equities creates the opportunity for larger potential gains in these low volatility environments. And in high volatility environments, an additional protection measure automatically kicks in, and a cash allocation strategy becomes available. Moving to cash helps maintain the index's target volatility of 5%, while also providing a performance buffer to protect on the downside. A closer look at the historical asset mix of the S&P Mark 5% Index shows just how dynamic this strategy can be. So what's the end result of this dynamic recipe? An index that provides 1. Greater potential for upside performance. 2. Diversification. 3. Rising rate protection. 4. Volatility reduction. To learn more about the S&P Mark 5% Index, visit www.spdji.com.